Hi, it's Andrew Faldy, and I want to take a few minutes and talk to you about why every trader should have a trading system. And we're going to take a little time and we're going to discuss what exactly is a system and all of the different levels of simplicity and complexity that are involved in that. First of all of this information is for educational purposes only. Anything we discuss could be hypothetical and is not intended for you to make important investing decisions, and you should always consult your investment advisor. There are many types of systems, and we're going to do an overview and look at the components of a system that I would call critical, and then those that are simple. So things that anybody could include, any trader can include, and that's why the bold statement, why every trader should have a trading system, because there are simple components that are systematic that every trader should be including, and every successful trader that I've ever encountered does include in their trading. And then we're going to go into all of the levels from a surface approach. We're not going to go deep into, a very comprehensive look at some of these things, but we're going to kind of gloss over and take a 30,000-foot view at also some of the complex layers of systems. On the smallest level would be a routine, and that would be anything from your daily routine, anything that involves your approach to the market, your systematic way of approaching the market, and this includes the probabilities that you are aware of. This includes your time frame. This includes anything that when you show up, this is how you approach the market. This is the theories you're based on. This is what you've been trained to look at, and how you filter all of the information that's out there, which on its own is too much information. You cannot process everything that's out there. So this is your routine for processing market information. Then there's guidelines that you have. These aren't hard and fast rules, but these are the general area, the boundary, the border that you place inside of the market to say, this is the segments that I am involved in, this is the styles that I will get involved in, and this talks about the levels of risk you're willing to take, either as it relates to all of your capital or portions of your capital, allocations of capital, etc. Then we get into some of the hard and fast rules, and this can be things like the max absolute amount of risk that you're willing to take on any type of setup, any type of idea. This could include the max allowable risk in any given sector, so you can't overweight yourself too much to something that's going on. This may include time frames. This may include max applied capital and then max allowable trade risk. Many different types of things, but this would be those hard and fast rules within the guidelines that you're going to follow. Third, in the levels and the types of systems, you start to get into signals. And that's the systematic way. A signal is something that it alerts you. It's just like when you're driving down the road and you're in traffic, there are traffic signals. If you're hiking through the woods and you see a sign, that is a type of signal. And that's what the root word of signal is. It's a sign. This is something where it causes you to pay attention. This causes you to take notice. It filters out everything else that's going on and brings something to light that's important. It could be something that says, don't do this. It could be something that says, only trade in this direction, or only trade these types of strategies here. Or it could say, if you're in, you need to be out. There's a myriad of signals available, and any of those would be part of a system. Thirdly, on the actual getting into technicalities and things you can measure as far as rule signals is filters, which is looking at that broad market of all the thousands of available instruments between options, futures, and stocks, and filtering out the opportunities that are available. And this could be done automatically. This can be done through something that is a manual search or partially manual search, where you apply certain criteria to a database, you pull that information out, and then you filter through it with your own criteria to go from there. And now we're getting into the levels of complexity, which is where we start to automate. And there's many types of automation, and there's simple levels that most traders can get involved in. One of those is automated order management. So that could be a stop limit type of order where if a certain criteria is met, then a limit order is placed. So nothing will happen until then, but that would be the way to get into the trade. Or if you're in a trade, this could be a automated order for trailing stops or conditional stops or time stops, etc. Then we get into automated risk management. This could say, rather than just a very simple 100 shares or one contract or max amount of dollar capital, where we actually started to get into automated processes for position sizing and risk management as far as stop distances, etc. And that can be done by a systematic approach to positioning that size rather than having to rely on yourself in the heat of the moment to make that decision. And finally, this is the deepest level of automation and complexity in a system would be to automate the entire approach to capital allocation and portfolio management, multiple positions, multiple sizes, where there's an interrelationship between sectors and stocks and positions and sizing and volatility and capital size and capital allocation, all of that stuff. And in the middle of all that, even though it seems like that last level is the golden goose as far as you just set it and forget it, there's always the final layer that there is oversight. There's human oversight because the computer doesn't know when things are going wrong. It's only being told to do what it needs to do. It doesn't realize if there's a disconnection or information that is not coming through. Always must be human oversight involved in these processes to make sure that things are happening the way they are intended to happen. Examples of routine. So this is where we're going to get into where we break some of these things down and explain in detail what exactly I meant by those criteria. Examples of routine could be what time of day, and that also involves maybe what time of week, month, or quarter, or year, depending on your time frame. If you are a investment portfolio manager, you may be looking at the quarters and years. If you are a trader, you're going to be driving into the shorter time frames, and if you're a day trader, you're obviously going to be looking at the what time of day you're going to repeat a process, and that is the idea of a routine. It's the systematic way, and we bring it back to the title of this presentation, is every trader should have a system. And that system says, why not repeat, why not systemize those components which are repeated or repeatable? And you can make those, and what that does, it takes your mental commitment and it takes all the mental effort involved in trading and it reduces it where it can be reduced, where things can be systemized, where things can be repeated in a regular way. We can take that off of your plate, we can take it off of your shoulders, and that can free you up for more of the creative thinking and the process that involves what you really do bring to the table, which is your human capability to interpret. So if we repeat that process, we schedule it, it can be done by a computer, it can be automated, but no matter what, if it's repeated, if it's something where that time of day or time of month, and you can systemize it either with a checklist or a spreadsheet or a computer routine, it doesn't matter what it is, anything you can repeat and schedule, it reduces the amount of mental capacity required, which frees you up for other things. Which part of that measurement is, whenever you're going to repeat something and it's something that's going to be done over and over again, we can apply what is called a key performance metric, or what some people call as a key performance indicator, KPI. And we have to identify what those key performance metrics will be. And this is to know if you're on track or need to make a change. So if on a daily basis you have determined that there is a certain amount of risk, or a certain amount of directional risk, a certain max loss that you expect to not surpass, then that would be something you can measure. If there's a capital gain target that you have, then that can be something that you measure. If it's a number of positions or a trade frequency, etc., anything that you can expect to see can be a key performance metric that you can measure as part of your routine. And that can be, again, automated. It can be possibly assigned to an administrator or somebody other than yourself, Anything that you can do as part of a routine or scheduled or automated helps free you up to focus on what you do best. And lastly for this video, and then we'll do the rest in future videos, are some examples of guidelines. And guidelines is what types of things like the following might be a watch list you will stick with. Maybe certain sectors, maybe you're going to focus on stocks alone or options alone or futures alone, and that would be a type of thing that you're going to stick with, or a way of generating a watch list. Maybe you're only going to trade higher volatility instruments in strategies that require or benefit most from higher volatility. Maybe you're going to trade things that are not pending news announcements for certain types of strategies or approaches that you have to the market. Another guideline is the amount of risk you will take per position. This is something that is very difficult to pinpoint at any point in time because there should be a range. And that would be an idea of what a guideline is. It's a guide. It is not a hard and fast rule. And so that amount of risk you take, you can set those guidelines for the minimum and maximum. And that first word was minimum. Maybe that anything that is below a certain minimum is not going to entice you or motivate you enough to pay attention to it well enough, and it could just be distracting you or taking your attention away from what you really should be focusing on. So if it's not worth a certain amount of capital, maybe it's taking up too much of your mental capacity and should not be included. So there can be that range of allowable risk that you take per position. Reasons to exit early, that can be a big gray area, but you can have those pre-identified as potentials. And those are things that you can write down and you can take note of on a systematic level and pay attention to those guidelines for exiting early. And I'll go back to that. Exiting early, that would be from either losses or gains, and depending on possibly outside factors outside of the trade itself. So if you're in a very strong market and you're in a short and the short is profitable for the day, could be that that is something that is contrarian to the market, and if it begins to actually show greater strength than the rest of the market, it's a very specific circumstance, but that's something I've seen happen quite often, where something that's kind of gone against the grain of the market and it's done very well, and the market starts to calm down and then it shows a great amount of strength all of a sudden. That could be a relative strength compared to the rest of the market that might be a good reason to exit. Strategies you employ, this should be a growing list. At the beginning of your trading career, might only be one or two, no more than a handful of strategies or setups that you can employ, and then over time you can add to that. But willy-nilly jumping to a new strategy you recently heard about or saw a video about or a webinar and just kind of throwing that into your toolbox of strategies could be a poor way to approach the market. So having that guideline of these are the strategies and types of strategies you're going to focus on and sticking with that and little by little expanding that and pushing yourself as you see success, wherever you see success, or as you see the market change, or as you have enough real evidence of other traders experiencing success in certain types of strategies that you can begin to employ those and learn those and add them in. And this is a key component to what I focus on, which is especially if those new strategies benefit most when your other strategies struggle. So if your core strategies are based on higher volatility and big trends and things that move, by learning a strategy that benefits when something doesn't move, so a mean reversion strategy or a market neutral or a premium selling strategy, by including those and pairing those together, you start to get that decreased volatility of returns and increased more consistency in your trading. That's it for this video. We have several more key points to go on. And if you would like further information on strategies and you want to stay up to date, send me an email personally. I'll make sure you get on the list to keep getting updates. You can send that over to Andrew at lessthanrandom.com. Write that out for you. Andrew at lessthanrandom.com. Van with an A, random.com. I look forward to your questions. If you'd like me to clarify anything in these steps and in this presentation, feel free to send me an email and I'll be glad to answer that. Thanks a lot. Have a good day.